Hello, I'm Jonathan Mays, editor-in-chief of Restaurant Business, and welcome to The Week in Restaurants. I'm joined by senior technology editor Joe Guskowski. Jersey Mike's is getting a new CEO in Charlie Morrison. We will talk about that major change to the sandwich chain. Red Robin also has a new CEO, and we'll wonder what that means. That was a big surprise this week. And Del Taco didn't last long under Jack in the Box's ownership. I have some thoughts on that, so we'll discuss that later on. Joe talks about disruptors on Tech Check. I wonder what he means by that. Joe, but let's start with the CEOs. What's going on at Red Robin?
I have no idea. This was definitely a surprise to hear that GJ Hart, who's been there for a few years, working on a turnaround of Red Robin, is now stepping down, and the chairman of the board is stepping in for him. This was a surprise because, Hart had architected this 3-year turnaround plan, which we're, midway through. I think we're about 2 years into it. And Red Robin it had been starting to bear some fruit. Their last quarter was good. Their same-store sales were positive, 3 or 4%, if I recall correctly. So it seemed that the things that he had been doing were working for Red Robin, and now he's passing the baton. In their canned statements, they said, now is the time to make this transition, yada, yada, yada. The incoming CEO says he wants to work on marketing and repairing the restaurants and also getting its finances in order. So, if you want to read into that, go ahead. I will note that Red Robin's stock, last I checked, was down about 54% year to date, which was worse than the other casual dining chains. So there is a possibility that, shareholders may have been putting some pressure on the company to make a change given the performance of the stock. That's just speculation. I have no intelligence to back that up.
Right. Red Robin is sort of an odd company. There are a handful of them on the public markets, frankly. And yeah, I start to wonder if this company is or should be sold. And frankly, probably should. Standalone companies like this have a tough time survive. It just being on the public markets is tough. It gets expensive to deal with, the financial reporting, dealing with shareholders of publicly traded companies is very difficult. So the entire process of being a public company, you have to spend millions of dollars on doing that. And you start to wonder if any of this is worth it. And Red Robin has been sort of really challenged for a while. I thought that late last year, and they did their pre-announced earnings in early January from late last quarter was a bit of a surprise. They perform really nicely. This year is a little tough, I think, on the markets, and a company like Red Robin's probably going to get punished a bit more than others. And then the issue, the one thing that bugs me about these things, frankly, Joe, in this situation, and we saw it also in Jack in the Box, which we'll talk about a bit later, is that the company starts thinking about the financial issues of it. They're going to improve the finances, and that's just a really tough combination. My sense is that, if you're going to let an executive have a 3-year plan, you're going to hire an executive. And GJ Hart, by the way, has an amazing track record. He's actually has been generally really good at his stops. And so you should probably let him see it through, especially if they start to see some positive results late last year. You should let them see it through and kind of ignore the stock price. The problem is now that the company is going to go into effectively what will amount to be a period in which they're going to be cutting costs, really. Let's face it. Because that's usually what that means. They're going to, when they start talking about finances, when they start talking about that issue in the announcement of the CEO change, that's to me, that's a generally long-term negative for a company, frankly, if I'm being very honest. And finances are important. Companies do have to make a profit. Profit's important. But in this business, especially if you're a full service concept, you have to You sometimes have to spend on labor, and you might have to overspend. You have to do, your stores have to be run really well, and you can't cheapen out on that. And so whatever they do has to be done in that sense. You have to be able to serve your customers the right way. So that's what, and it's a similar situation to Jack in the Box. Jack in the Box is not a full service concept, but they were, in that case, Lance Tucker, who was a CFO for mere weeks, was elevated into the CEO spot after the departure of Darren Harris. And immediately, even before he became the CEO, he was immediately talking about financially right-sizing the company. Now the company is doing all sorts of massive things, which we'll talk about in a minute. But it's sort of, these things, the CEO changes happen, and they are often people. It's one of the few jobs that you get let go, not really because you're actually necessarily a bad CEO or a bad boss or not doing your job, but just because the board decides, well, we need to go in a different direction. And so, but I wouldn't be surprised if they get sold. That's my little prediction.
Yeah. I'll just say that, casual dining is hard enough as it is. It's very competitive right now. And they're serving burgers and beer, which you can get anywhere. You can get burgers at fast food. So it's a tough concept to really turn around, I think.
Right. Yes, it definitely is. All right, Joel, let me tell you about the other one that we had this week.
This morning.
Yeah, well, this morning when we're recording it. This probably goes out on Friday, so yesterday, I guess, technically.
Right.
But yeah, we had 2 back-to-back CEO changes, and this one actually less surprising than the GJ Hart news. And that's and that is Jersey Mike's will get a new CEO next week in Charlie Morrison. Charlie Morrison led Wingstop from 2012 to 2022. He's had other stops along the way. Before that, he was the CEO at Pizza Inn when they created Pie 5, a fast casual pizza concept. When Charlie Morrison was at Pizza Inn, he'd actually done a pretty good job at that company. It hasn't really been the same since he left. And then he kind of surprised. The big surprise is that he left Wingstop and left Wingstop and then went to Salad and Go, which was a not a known chain at the time. And he left last year under what was admittedly a difference with the board of directors. A rare situation in which we are told that the CEO had a difference in opinion with the board of directors. We never hear that. We never, ever hear that. You usually have to actually do some journalistic work, but that one, I will say, was relatively easy. Any event, he takes over for Peter Cancro. Peter had led the brand for 50 years. Company was sold to Blackstone earlier this year. Peter had told me a few weeks ago that he would, that eventually they're going to hire a CEO. So this wasn't really a surprise. Yeah, Charlie will be good for the company. He will fit the culture pretty well. He's a pretty approachable dude. He's not really, on balance. He should fit the culture exceptionally well. These things are always a risk, man. Anytime you're going to change, you're going to change ownership, and of course, a CEO change is almost inevitably follows. Eventually, Peter wasn't going to stay there forever. He's been leading that brand for 50 years. That's a long time.
He had been there so long. That's to me is the biggest risk, is that you're really, the longevity and the institutional knowledge that he has, I think was such a big part of their success. Not that I'm doubting Morrison at all, but that's a big change.
Yeah. I think, they should be able to work really well together. The other big risk, frankly, Peter's going to be the chairman. Peter's a great dude. They're both really good guys. I like them. But, there can be a risk when you have the guy who founded the chain, who had led the brand for as long as he did, sitting over as chairman. It could be tough. I think it could be tough on a CEO to have the previous guy, who's pretty much synonymous with the brand, kind of looking over your shoulder. I think that Charlie has a mentality for it, but it is a risk. I think it's been a challenge a bit at Starbucks. They won't admit it. but it's one of those. It was, I think, a challenge at Starbucks more recently with Howard Schultz, who effectively founded the brand, kind of looking over the management's shoulder and stuff like that. And we've seen it in past situations. It can be hard on executives. So that's kind of another risk. And then of course, I mean, that just a change, as you mentioned, that's a long time. 50 years is a ridiculously long time. I mean,
is that a record? Is there a CEO?
That must be a record. I mean, that's actually good. That's worth looking up, right? I mean, I don't think so. I think it is. I mean, I don't think anybody has led a brand this long. I haven't. It's rare air. I mean, you have to go maybe Fred DeLuca. No, not Fred DeLuca. So I was thinking Fred DeLuca died when he was in his 60s. And, he had led that brand. So he didn't last 50 years. So you would have to go, maybe someone at White Cat, like we'd have to look that up, but that has to be, it's up there. It is up there. That's a long time to run a company, so in that sense, it's completely surprising that he was still there.
Do you get the sense that he is just ready to step back a little bit, or this is like BlackRock forcing his hand?
No, he wants to step back. I mean, he does. He definitely does. I mean, I've spent time with him. He's he'll say that, like, he's like, it's basically time. He's been there 50 years. And, we've been following this for the last couple of years, where he's been thinking about what to do next, because he is getting up there. And, that's hard. It's a big company at this point. It's a 3,000 unit chain. It's eyeing other markets. And, this is his baby. He loves this thing. I think he definitely wanted to sort of step back. And he's going to be still involved in some form or fashion. He's still the chairman for however long that lasts. And, I mean, he's, you could see him getting into investing or something along those lines. He's not going to completely go away, but, yeah. It's not really a Blackstone thing. I mean, I think, frankly, Blackstone would probably have preferred him staying around as CEO, because he did create it and he knows the culture. He knows everything else. It is less risky to keep, if you're a private equity firm and you buy a concept, a lot of times it's management you're looking at. And if a company has really good management, you sort of want to keep it. So I think they probably would have preferred him sticking around. But the reason why Peter would sell is that he wanted to take a step like this, for sure. No, it's definitely an interesting one. Charlie Morrison I think he'll be good for the brand ultimately. I'm not saying that Jersey Mike's couldn't potentially have challenges coming out of this. There are always this sort of thing. They are going from being owned by the same guy for 50 years to being owned by a private equity firm. That in and of itself is a potential challenge. The new management is a challenge. There's a lot of change for a company that hasn't really had it. So you never know what can happen. I mean, Charlie's got a pretty good mentality. That's kind of what they talk about. He's a good fit. The other big news of the week, and probably the big one, Joe, is Jack in the Box is selling Del Taco.
Yeah.
Let me tell you about this one. Jack in the Box bought Del Taco in 2022 under former CEO Darren Harris for $575 million. And then talked about all sorts of things, like, we're going to get synergies, like $50 million a year in synergies. That's cost cuts. That's layoffs, Joe. That's layoffs of employees at the corporate level. Yeah, that's what they mean by synergies. People getting fired. Well, and then also savings on supply chain, whatever. But most of the time, it's people not being hired and whatever. They talked about the fit of culture, the fact that they're both from Southern California. There's this interesting thing that Jack in the Box is a burger chain that sells tacos. Del Taco is a taco chain that sells burgers. So they got that weird California thing going on. But then, earlier this year, Darren Harris leaves, somewhat surprisingly, and then replaced by, as I mentioned before, CFO Lance Tucker, who was literally just hired to be CFO. He had been at the company before, but he left in 2020. And then Tucker wasn't even actually given the title interim CEO. What he was given was like interim principal executive officer at first. And then he was basically given the CEO title really within a short period of time. And then only a couple of weeks after that, after he's named permanent CEO, then he sends out this detailed list of financial changes that the company is going to make. All of this happened. The departure of the first CEO, or the hiring of Lance Tucker as CFO, the departure of the CEO, the permanent hiring of Tucker as a CEO, and then this entire plan all have taken place since early January. It's an amazingly quick time. And now they are selling real estate. They're going to close 150 to 200 Jack in the Box locations. And now they're going to sell Del Taco and simplify the business to operate just one brand. So they're going to be a single branded company. And Jack in the Box hasn't been growing forever. That's the thing that Darren Harris was trying to fix. But Del Taco it's a challenge, frankly. And they're not going to get $575 million for Del Taco. They're going to take a loss. But this is it's commonplace, man. It's actually pretty common for brands to say, maybe we shouldn't own this.
Cut our losses.
Mm-hmm. Right. And you do this, frankly, because Jack in the Box is making the decision that they are better off just cutting their losses and getting what they can for Del Taco. So you'd probably get it relatively cheap. And then just moving on as a standalone brand, which kind of tells you how bad Del Taco has become over the past few quarters. That it's better off not owning it. In fact, they said that it really wouldn't do much for their earnings in the coming years, which says everything about the way Del Taco is.
What a mistake to even do the deal in the first place. I mean, I get the sort of quote unquote synergies and the California connection and everything, but I mean, it's not like Del Taco was blowing the doors off a couple of years ago either, was it?
No, it hasn't been. I mean, the interesting thing is, the funny thing about the current market show is we've been looking at top 500 data lately, and Mexican brands have killed it on balance. But the Mexican brands that have killed it are fast casual Mexican brands, fast food Mexican brands outside of Taco Bell are all really not doing very well. In fact, let me pull up some numbers and look at them. And I'll share you some numbers about Mexican concepts, because it's pretty interesting what's happened in that particular market. If I could find it. There we go. So you got Taco Bell, which grew by 8% last year. And, Taco Bell is 16 times the size of Del Taco.
It's the only national fast food Mexican chain.
Yeah, really. I mean, Del Taco is a regional chain. Del Taco down 2%. Taco John's down 3%. Taco Bueno down 7%. Taco Time down 5%. Baja Fresh down 3%. And right now we're Baja Fresh is not even in the top 500. So, there are 5 fast food Mexican brands. None of them did well. You actually have to go down to a brand called Taco Casa, which is up 5 before you're going to get any growth among fast food. None of these companies. You really have to get like really small change. Meanwhile, you go on the fast casual Mexican side, Chipotle up 15%, Qdoba up 10%, Moe's Southwest Grill down, but Torchy's Tacos up 12%, Cafe Rio up 5%, and then that whole sector I think is up 8+% total
that
sales.
Is so interesting.
Mm-hmm. Yeah, and Del Taco just hasn't really done anything. They have bad locations. Some of those apparently, one source was telling me that some of their who had looked at the company a while ago, was telling me that some of their locations are so small, they just can't do anything with them. You have such small locations, you just can't really do anything with them. And in some cases, they ripped out employee lockers to fit the syrup for the soda machines. So if you're an employee at a Del Taco, at some of these Del Taco locations, you don't even have a place to put your purse.
Find a chair.
Yeah, you just gotta whatever. So there's that sort of situation. So yeah, I mean, they're not going to get $575 million for it.
Who's going to want to buy that thing?
Somebody will buy it. The lesson, Joe, here in the restaurant business, somebody will always buy it because there's going to be money to be had. And, let's say, and let's just throw a number out there because I really have I'm not privy. They're not going to get $575 million. They're probably not even going to get, let's just say you can buy Del Taco for $50 million.
50?
Well, it wouldn't surprise me.
Wow.
That is me throwing, like, I'm literally that I'm spitballing that I have no evidence about it. But let's just say, like, you think you could get it for $50 million, and you are going to get a perceived deal. Go back to Macaroni Grill. Remember that? Remember I told you about? We talked about Macaroni Grill, and then they lost like 95% of their value in just a few years through multiple deals, and they were sold for they were bought for $55 million 1 year, and less than 2 years later they were sold for $8 million, and then 2 years after that, both of the buyer and the seller ended up in bankruptcy. One of my favorite stories. So. I mean, there's a perceived deal. Somebody will buy it because they'll think they can make it work, and they'll think there needs to be another fast food Mexican brand. The argument, as you said, no, the world does not want a QSR Mexican brand. They don't. They're the fast food world, the fast food customer has absolutely chosen the winner there. It is Taco Bell. Nobody is even close. Nobody is doing particularly well. None of these brands really have the cachet, whatever it is that Taco Bell has. And Taco Bell is something because they don't have anything. At least McDonald's has Wendy's, for God's sakes.
Mm-hmm.
And they got Subway, and Jersey Mike's is like surging, and Subway's losing business. Most of these sectors have a couple of competitors. Even Chipotle has Qdoba. I mean, Qdoba is only 10% Chipotle size, but Qdoba 10% last year is actually really good, especially for them. So yeah,
it makes Taco Bell what they've done just that much more impressive when you consider what the rest of those brands have done.
Yeah, are you a fan of Taco Bell?
I am personally not a big Taco Bell guy. My wife loves it, so I go, fairly often. And I never know what to order. I'm always disappointed, and it always seems too expensive. So I would never choose to go there, but I do by default.
Yeah. I always joke that I aged out of Taco Bell years ago, but it's a brand that I absolutely appreciate. I do actually have my favorites.
What's your go-to?
Actually the thing that I prefer the most, oddly enough, is just the bean burrito, the simple bean burrito. I'm a simple man with simple taste, Joe.
I think they do the simple stuff better, honestly. I agree with you.
Mm-hmm. Yeah.
Tacos are good.
Some of the stuff I was at their Live Moss Live a couple months ago, and some of the stuff they're actually coming out with is really, really rock solid. They've got some interesting stuff. They can do stuff other brands can't. They're super irreverent. So the brand just really works. It has a very good formula, and nobody can compare to them. They've got their competitors. They have so badly trounced their competitors in the fast food Mexican world that, and then, by the way, if you wanted to buy a Taco Bell, good luck. You're going to spend a lot of money. That is the most valuable franchise to buy. So, yes. All right. That should do it for this week's conversation on the week in restaurants. Coming up, we will have Joe talking about disruptors. That would have been a really fascinating piece that he had written this week on Restaurant Business Online. But first, whatever ad Spoons throws up next.
Our industry is grappling with uncertainty. At the 2025 National Restaurant Association Show, you'll explore innovative solutions, strategies, and partnerships that will prepare you for whatever comes your way. Take it from me, the show has everything you need to elevate your front and back of house. You'll see, touch, taste, and demo the latest trending products across more than 900 categories, including food, beverage, technology, equipment, and more. Don't miss the industry's most trusted event taking place in Chicago, May 17th to 20th. Secure a badge by May 9th to save $30. Register today at nationalrestaurantshow.com. Rate quoted ends on May 9th and applies to operators only. Non-exhibiting suppliers are subject to a higher badge rate. Please check out the show's website.
Hello, and welcome to Tech Check, where I, Joe Guskowski, talk really fast about one big topic in restaurant tech. This week, remembering the disruptors. So back in the late 2010s, the idea of the disruptor became very popular. This referred to a company or a trend that seemed poised to upset the status quo. Here at Restaurant Business, we used to run a regular feature about potential disruptors in the restaurant industry. We actually got a lot of them right. Automation, third-party delivery, private equity, just to name a few. But plenty of those so-called disruptors didn't quite pan out. There was Amazon's restaurant delivery service, which ultimately couldn't compete with the other providers. There was Zoom Pizza, which tried cooking pizzas and moving vehicles, which turned out to be pretty messy. And of course, there were ghost kitchens, which boomed during the pandemic, but have fizzled out since, largely due to a lack of demand. The big takeaway from all of this is that it's hard to reinvent the hospitality business with technology, but that certainly won't stop people from trying.
And that should do it for the week in restaurants, which was edited, as always, by Spoons. Artwork by Nico Hines. You may find this and other episodes of the podcast on our website at restaurantbusinessonline.com, but please subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, the editor-in-chief of Restaurant Business. Thank you for listening.